If you're trying day trading and you're still losing money, this video might be the reason you finally stop. Because 90% of beginners fail in day trading, not because trading doesn't work, but because they were never taught the right way. No fake profits, no signal groups, no get-rich-quick lies. In the next 45 minutes, I'll show you exactly how day trading really works in 2025, step by step, using the same proc.
Gold has always been one of the most traded and respected assets in the global financial markets. But trading gold in 2025 requires a completely different mindset compared to previous years. Due to ongoing inflation cycles, interest rate uncertainty, geopolitical tensions, central bank policies, and the growing influence of algorithmic and institutional trading, gold has become more volatile, more aggressive, and at the same time more predictable for those who truly understand how it moves. This full video course is designed to teach you how to trade gold professionally in 2025 using a simple, logical, and repeatable system that focuses on market structure, liquidity, price action, and strict risk management rather than complicated indicators. Gold trading means speculating on the price of gold against the US dollar, known as XAU/USD. And unlike traditional forex pairs, gold behaves differently because it is both a commodity and a safe haven asset. Gold reacts strongly to economic uncertainty, inflation expectations, interest rate decisions, and global risk sentiment, which is why it often moves fast and aggressively, trapping inexperienced traders who overleverage or chase price without a clear plan. Most traders lose money trading gold, not because gold is impossible to trade, but because they trade without structure, without patience, and without proper risk management. Common mistakes include using too much leverage, trading during high-impact news events, entering trades without confirmation, relying on too many indicators, trading every session, and allowing emotions such as fear and revenge to control decisions. Professional gold traders understand that consistency does not come from winning every trade, but from managing losses and letting profitable trades run according to a predefined plan. The foundation of successful gold trading is understanding market structure, which simply means identifying whether the market is forming higher highs and higher lows in an uptrend or lower highs and lower lows in a downtrend. Gold respects structure extremely well on higher timeframes, such as the daily and H4 charts, and these timeframes should always be used to define the overall market bias before looking for entries. Lower timeframes like M15 and M5 are best used only for precise execution, never for bias. One of the most critical elements in gold trading is knowing when to trade and when not to trade. The best trading opportunities in gold usually occur during the London and New York sessions when institutional volume enters the market, while the Asian session is often characterized by low volatility, ranging behavior, and manipulation. Gold moves with purpose during London and New York because this is when large players hunt liquidity and position themselves. Liquidity is the true engine behind gold price movements, and liquidity simply refers to areas where many stop losses are placed, such as equal highs, equal lows, previous day highs and lows, session highs and lows, and obvious trendline breaks. Institutions push price into these areas to collect liquidity before moving price in the intended direction, which is why many breakouts in gold fail and reverse sharply. Understanding this concept alone can completely change how you see the market. Support and resistance in gold should be drawn cleanly and logically, focusing only on major highs, major lows, and key structure points, rather than cluttering the chart with unnecessary lines. The core gold trading strategy taught in this course is based on identifying the higher time frame trend, marking key liquidity zones, waiting patiently for a liquidity sweep, and then entering only after clear confirmation on a lower time frame. The first step is always to determine whether the market is bullish or bearish on the H1 or H4 time frame, and to trade only in that direction. The second step is to identify where liquidity is resting, such as equal highs or lows or previous session extremes. The third step is to wait for price to sweep that liquidity by briefly breaking above highs or below lows and then showing rejection. No liquidity sweep means no trade. The fourth step is confirmation, which can be a strong rejection candle, an engulfing candle, or a clear shift in market structure on the lower time frame. Only after confirmation should an entry be taken. Stop-loss placement should always be logical, placed beyond the liquidity sweep high or low, and never moved emotionally. Take-profit targets should aim for the next logical liquidity zone with a minimum risk-to-reward ratio of at least 1 to 2. Risk management is the most important part of trading gold, and no trade should ever risk more than 1 to 2% of the account balance. Even the best strategy will experience losses, but proper risk management ensures survival and long-term growth. Position sizing in gold must be calculated carefully because gold has a large pip value, and emotional lot sizing is one of the fastest ways to blow an account. Psychology plays a massive role in gold trading because gold's fast movements can trigger fear, greed, and impatience. Successful traders remain calm, wait for their setup, accept losses as part of the process, and never revenge trade. High-impact news events such as NFP, CPI, FOMC, and interest rate decisions should generally be avoided as gold becomes highly unpredictable during these times. A simple daily gold trading routine includes checking the higher time frame bias, marking liquidity zones, waiting patiently for a liquidity sweep, entering only with confirmation, managing risk strictly, and journaling every trade. Journaling is essential for improvement as it allows traders to identify patterns in their behavior, mistakes, and strengths. Many myths in gold trading include the belief that gold is random, that indicators are required, or that trading every day is necessary. In reality, gold rewards patience, discipline, and clarity. Professional traders often win only 40 to 60% of their trades, but they focus on risk to reward and consistency rather than win rate. Realistic expectations are crucial, as no strategy can guarantee profits or eliminate losses entirely. The final rules for gold trading are simple: trade with structure, respect liquidity, manage risk, stay disciplined, and remain patient. This content is for educational purposes only and does not constitute financial advice. Trading involves risk, and past performance does not guarantee future results. If you truly master market structure, liquidity behavior, and risk management, gold can become one of the most profitable instruments you ever trade, not because it is easy, but because you approach it like a professional rather than a gambler. As traders continue developing their skills in gold trading, it becomes increasingly important to understand that consistency is built through repetition, discipline, and the ability to think in probabilities rather than emotions. Many traders fail not because their strategy is bad, but because they lack the patience to wait for ideal conditions and the confidence to execute their plan without hesitation. Gold rewards traders who are selective and punishes those who trade out of boredom or impulse. One of the most overlooked aspects of gold trading is the importance of context. Every trade must make sense within the broader market narrative, meaning the higher time frame trend, recent price behavior, and current market conditions must all align. Entering a trade simply because price touched a level is not enough. There must be a clear reason, supported by structure, liquidity, and confirmation. Another key factor in gold trading is understanding consolidation and expansion phases. Gold does not trend all the time. It often spends long periods consolidating before making explosive moves. Professional traders wait for consolidation to form near key levels and then look for liquidity grabs that lead to expansion. These expansion moves are where the most profit is made, but only if the trader is prepared and positioned correctly. During consolidation, many retail traders get chopped up because they overtrade small movements, while institutions patiently build positions. Recognizing when the market is ranging versus trending can save traders from unnecessary losses. Volatility is another crucial element to consider when trading gold. Gold volatility can increase suddenly due to unexpected news, shifts in risk sentiment, or large institutional orders entering the market. This is why stop-loss placement must always account for gold's natural volatility rather than being placed too tight. Tight stops may work in calm markets, but gold often requires more breathing room to avoid being stopped out by normal price fluctuations. At the same time, wide stops must always be balanced with proper position sizing to maintain consistent risk. One of the biggest mindset shifts a gold trader must make is accepting that missing trades is part of the process. There will be days when price moves perfectly without you, and chasing those moves almost always leads to losses. Professionals understand that opportunities are endless, but capital is limited. Protecting capital should always be the #1 priority. This mindset allows traders to approach the market calmly and objectively rather than emotionally. Another advanced concept that improves gold trading performance is understanding premium and discount pricing. In an uptrend, traders should look to buy gold at discounted prices relative to recent highs, while in a downtrend, selling at premium prices near highs provides better risk-to-reward opportunities. This simple idea prevents traders from buying tops